If you still think that with me gone, no one will be left to scold you awake from your foolish actions, then you're sorely mistaken. Universal wisdom does not vanish with the death of the body, and mathematical laws certainly do not. Just as Coca-Cola's formula does not lose its magic because I'm no longer here, and the calculation of compound interest does not change its formula with the passage of time. I'm watching you from another world, watching this crazy year of 2024. I see the global capital markets acting like a spoiled child, surging one moment over a policy rumor and crashing the next over a Twitter post. I see people complaining about inflation eroding their wealth while pouring money into the most fragile assets. I also see that man Donald Trump standing center stage once again, waving the tariff stick with the same confidence as President Hoover did when he signed the Smoot-Hawley Tariff Act all those years ago. I know what many of you are thinking. You're whispering to yourselves, Charlie, you used to be bullish on China. You and Warren bought BYD. You said China's economy had incredible resilience, and you even claimed Chinese entrepreneurs are more diligent than their American counterparts. Yes, I did say those things, but you forgetful lot always choose to ignore the other line I repeated time and again. When the facts change, I change my mind. What do you do, sir? The facts are undergoing a dramatic, irreversible shift. The current landscape is worlds apart from when I invested in BYD. Back then, China's manufacturing sector built the world's most complete supply chain on the back of low costs, high efficiency, and an open trade environment. But now, the bridges of trade are being washed away by the flood of politics. If Trump actually follows through on his promise to impose 60% or even higher tariffs on Chinese goods, remember that number, 60%. This isn't something I made up out of thin air. Just as the 1930 Smoot-Hawley Tariff Act raised tariffs on over 20,000 goods to historic highs, history always repeats itself. This will no longer be a simple trade dispute. It will be a Lollapalooza Effect, a superstorm where tariff shocks, exchange rate volatility, supply chain disruptions, capital outflows, and other negative factors converge and amplify each other. I've witnessed countless market crashes, the Great Depression of 1929, Black Monday in 1987, the 2008 subprime crisis. Every single time, a group of people who thought they were smart ended up ruined. They all shared one trait. They ignored obvious risks, clung to the so-called valuation advantage, and only regretted it when the storm hit. Today, I'm not here to recommend stocks. I can count the number of stocks I've recommended in my life. On one hand, I'm here to save lives. Just like I warned Warren to stay away from airline stocks back in the day. Now I'm warning you, if your portfolio still holds the three types of Chinese assets I'm about to mention, whether as shares, Hong Kong stocks, or Chinese concept stocks, no matter how cheap they look right now, no matter how fancy the target prices analysts are peddling, my advice to you is one word: get out. Immediately right now, because in the face of a tsunami, you don't need to swim faster than a shark. You just need to reach shore before everyone else. And right now, the tsunami is already forming on the horizon. Those still picking seashells on the beach are destined to be swallowed whole. Remember, the first rule of investing is to survive, not chase so-called excess returns amid risk. Before we discuss exactly what to sell, I need to brainwash you a little with my favorite tool. Invert. Always invert. I've solved countless complex problems in my life using inversion. If you want to make money in investing, first figure out this. How can you completely wipe out your wealth over the next 4 years? It's simple. Just 3 steps. First, borrow a ton of money, max out your leverage, and make your balance sheet as fragile as a piece of paper. One little gust of wind will tear it to shreds. Second, pour all that borrowed money into a business with no pricing power whatsoever, that relies heavily on a single market, letting others hold your fate in their hands. Third, pray that the ruler of that single market, namely Trump, will show you mercy, that he'll suddenly turn kind and benevolent. This is exactly what many so-called value investors are doing right now. They salivate over Chinese export stocks with P/E ratios of just 5 or 6 times, but ignore the elephant in the room, political risk. They think a low P/E equals value, forgetting that value depends on a stable operating environment and sustainable profitability. Just like people once thought us railroad stocks were cheap, but forgot that the rise of the automobile would completely upend the railroad industry, they now forget that tariffs will utterly destroy export-dependent businesses. Trump's tariffs aren't just taxes, they're moat fillers. You know, my favorite business concept is the economic moat. Costco's moat is its membership system and low-cost procurement. Coca-Cola's moat is its brand and distribution network. BYD's moat is its technological R&D and industry chain integration. These moats are strong and enduring, capable of withstanding competitors' attacks. But if your moat is built on low-cost labor and export tax rebates, a 60% tariff will fill that moat overnight. Let's revisit history. In 1930, the Hoover administration signed the Smoot-Hawley Tariff Act, raising the average tariff on us imports from 40 to 60%. What was the result? Global trade volume plummeted by 66%. U.S. imports and exports dropped by 67%. The Dow Jones Industrial Average fell 89%. Unemployment soared to 25.1%, and it directly triggered the Great Depression. Back then, U.S. farmers and manufacturers who relied on exports thought government tariffs would protect them. Instead, they faced retaliatory tariffs from other countries, couldn't sell their products, their businesses collapsed, and they were left to swallow the bitter pill. How eerily similar the present is to the past. Trump's tariff policies have already sparked corporate anxiety. The Institute for Supply Management's November survey showed the manufacturing index has fallen into contraction territory, with the employment sub-index dropping to 44%. Multiple industry executives have stated that current supply chain uncertainty is more challenging than during the COVID-19 pandemic. And this is before the full implementation of tariff policies. If 60% tariffs actually take effect, the consequences are unimaginable. You need to understand, these tariffs are nothing like previous trade frictions. Past tariffs were partial and temporary. These are comprehensive and long-term. Trump's core goal is manufacturing reshoring to the U.S. to achieve this. He will spare no cost, even if it means sacrificing short-term economic growth. This means tariffs are not a negotiating chip. They are the ultimate policy objective. For Chinese companies reliant on U.S. exports, this is not a temporary difficulty. It is an existential crisis. When the moat disappears, your profit margins disappear with it. I've checked the data. The average operating profit margin of China's light industry is only 6.54%, and the net profit margins of pure export-oriented industries like textiles and small home appliances are even lower, ranging from 5 to 8%. Imagine what happens to your profit margin when a 60% tariff is slapped on your products. The answer is negative. When profit margins turn negative, businesses lose money. When losses persist, stock prices won't just halve, they'll be completely wiped out. Warren has been selling off a lot of stocks lately, holding hundreds of billions in cash. Do you think he's gone senile? On the contrary, he's the sanest person in this market. He knows the storm is coming, so he's hoarding cash, waiting for the opportunity to buy at rock bottom prices. And the core of this storm is the accelerating decoupling of global trade. We are moving from an interdependent global economic system to a fragmented, confrontational one. In this process, assets caught in the crossfire are destined to be destroyed. So stop judging the current market by past experience. You might have made money buying export manufacturing stocks over the past decade, but over the next 4 years, those stocks will bleed you dry. Because the facts have changed, and if you don't change your mind, you'll be eliminated by the market. All right, take out your notebooks and write this down carefully. The first category of assets you must liquidate immediately is pure export-oriented manufacturers with no brand pricing power. I want to emphasize two key phrases: no pricing power and pure export-oriented together. These two traits are a fatal combination. First, what does no pricing power mean? It means your products are essentially identical to your competitors. Customers can easily replace you, and you can only win orders by cutting prices. Think of small home appliance companies that do OEM for Walmart or Target. Their rice cookers and blenders are the same in function and quality, differing only in the brand label. Or the textile industry, which produces socks and t-shirts with no brand premium, where customers only care about price. These businesses are like vendors in a wet market, forced to accept whatever price the market dictates, with zero bargaining power. Compare that to BYD. Does BYD have pricing power? Absolutely. Its new energy vehicle technology is nearly irreplaceable in European and Southeast Asian markets, and its blade battery and DM-I super hybrid technology are beyond competitors' reach in the short term. So even in the face of tariffs, BYD can adjust by raising prices or shifting market focus. But what about pure OEM manufacturers? They have no technological barriers, no brand advantages. Once tariffs are imposed, they're caught between a rock and a hard place. Let's do a math problem, so simple a schoolchild could solve it. Suppose a Chinese OEM makes a small home appliance for $90 and sells it to a U.S. customer for $100, earning a 10% net profit margin. After a 60% tariff is added, the import cost of that appliance jumps to $160. Who foots the bill? Will us consumers bear part of it? Maybe, but only a small fraction. Because U.S. consumers have plenty of options. They can buy products made in Mexico, Vietnam, or even the U.S. itself. If your product's price rises by 60%, they'll abandon you instantly and switch to cheaper alternatives. So most of the tariff costs will ultimately fall on the manufacturer. If you refuse to lower prices, you'll lose all your orders, and the business will collapse from lack of revenue. If you do lower prices, cutting them below 100, you'll lose money. Your cost is 90, and with tariffs added, every transaction will bleed you dry. It's a losing bet no matter which way you turn. The outcome is destruction. I've seen countless companies like this. They seem busy, factories lit up around the clock. Machines running 24/7, annual revenues in the billions or tens of billions. But their net profit margins are pitifully thin. They're essentially doing charity for U.S. retailers and consumers, using their meager profits to prop up America's low inflation. These businesses are like candles in the wind. The moment the political winds shift and tariffs are imposed, they'll be snuffed out instantly. The data is already sounding the alarm. According to CNBC reports, the U.S. labor market is already weakening, and tariff policies have caused some U.S. companies to start layoffs and adjust supply chains. China's export data also shows that while exports of smartphones, laptops, and other products remained large in the first 10 months, growth has slowed significantly. This is just the impact of tariff expectations. If 60% tariffs actually take effect, exports of these products will plummet off a cliff. Don't tell me they're cheap with a 5 times P/E ratio. I'll teach you a simple investment logic. P/E equals stock price Fe earnings per S-hair EPs. If next year's EPS drops to 0 or even turns negative, that current 5 times P/E will become infinite. Stocks that look cheap now are actually the most expensive because their value will be wiped out completely. In my investment career, I've never bought a business without pricing power, because I know that a business without pricing power is like a castle without a moat, easy for competitors to breach and vulnerable to external shocks. I'd rather pay a premium for a great company with strong pricing power than a bargain price for a mediocre one without it, because great companies survive storms and emerge even stronger, while mediocre ones vanish entirely. So audit your portfolio if you hold any of the following. Liquidate immediately. Small home appliance, OEMs for us retailers, unbranded textile and apparel companies, low-end machinery parts manufacturers, and electronic assembly plants without core technology. These businesses rely on U.S. exports, lack strong brand moats, and have no pricing power. Once tariffs are imposed, their fate is sealed. Sell them and don't look back. Don't hesitate over short-term rebounds, because that's just the calm before the storm. The second category of assets to liquidate is a bit more complex. It involves the macroeconomic linkage effect, or what I often call second-order effects. Many investors only see the direct impact of tariffs, but ignore the chain reactions they trigger. And these reactions are often more deadly than the tariffs themselves. Let's use inversion to reason through this again. What happens when Trump raises taxes? First, U.S. domestic commodity prices will rise because imported goods become more expensive, directly pushing up U.S. inflation. According to the OECD, the impact of higher tariff rates hasn't fully manifested in the U.S. economy yet, but as policies are fully implemented, they will continue to pressure prices upward. What does rising inflation lead to? The Federal Reserve can't cut interest rates. It might even have to hike them again. The Fed's core mandate is price stability, and when inflation exceeds its target, it must adopt tight monetary policy. We've already seen the Fed raise rates multiple times in recent years to curb inflation, driving the U.S. dollar index sharply higher. If tariffs further fuel inflation, the Fed will likely keep rates high or even hike again. What does high interest rates bring? The U.S. dollar will keep strengthening, draining global liquidity. According to IMF research, every 10% appreciation in the dollar causes emerging market economies to see a 1.9% drop in GDP output after 1 year. A drag that lasts 2.5 years. A stronger dollar will trigger capital outflows from emerging markets back to the U.S. as investors chase higher risk, free returns. This is when disaster strikes companies in this category, capital-intensive enterprises with large U.S. dollar debt but only RMB revenues. These businesses have a fatal flaw in their business model, a currency mismatch between income and liabilities. They borrow in dollars and need to repay principal and interest in dollars, but their core operations are in China, generating RMB revenues. This mismatch becomes a ticking time bomb as the dollar strengthens and the RMB depreciates. The most typical example is China's real estate companies. According to CRIC data, Chinese developers face debt maturities of up to 525.7 billion yuan in 2025, with offshore debt totaling approximately 4.3 billion. These developers borrowed heavily in dollars in recent years to acquire land and fund projects, but now their sales are persistently weak, with new home sales failing to stabilize. They can only survive through debt restructuring. Country Garden plans to slash its total debt by 11.6 billion, a reduction of about 70%. Sunak China's onshore debt restructuring plan involves over a 50% debt haircut. This means investors holding these developers' stocks face massive losses. Imagine a developer owes $100 million in dollar debt. At current exchange rates, it needs 700 million yuan to repay. But if the dollar strengthens and the RMB depreciates by 10%, it will need 770 million yuan. And with its houses unsellable and revenues in decline, it has no way to secure enough RMB to convert into dollars for repayment. This is what I call a double whammy. Asset values plummet while liabilities skyrocket. Beyond real estate, some capital-intensive infrastructure, aviation, and traditional industrial groups face the same risk. Airlines mostly purchase aircraft with dollar loans and must repay substantial dollar interest each year. Infrastructure companies' overseas projects often require dollar financing, but their revenues may be in local currencies or RMB. Traditional industrial groups like steel and chemical companies may also have dollar liabilities from imported raw materials. These capital-intensive enterprises share another common problem: poor asset liquidity. Real estate companies' assets are unsold homes. Airlines' assets are aircraft that can't be easily liquidated. Infrastructure companies' assets are long-term engineering projects. When facing debt crises, they can't quickly sell assets to repay debts. Meanwhile, dollar debt creditors often enforce strict repayment terms. Default triggers lawsuits and asset freezes, leading ultimately to bankruptcy. I've hated uncontrolled leverage and currency mismatches my entire life. The companies Warren and I invest in have abundant cash flow, healthy balance sheets, and no large foreign currency liabilities. Because we know leverage is a double-edged sword, it amplifies gains in good markets but accelerates ruin in bad ones. And currency mismatches make businesses extremely vulnerable to exchange rate fluctuations. Right now, the dollar's strengthening trend is crystal clear. As Trump's tariff policies advance, U.S. inflationary pressures will mount. The Fed will keep rates high longer than expected, and the dollar index will likely hit new all-time highs. For Chinese capital-intensive enterprises with high dollar debt, this is a death sentence, so audit your portfolio. If you hold any of the following, liquidate immediately: real estate companies with large debt maturities and high dollar debt ratios, airlines with high asset liability ratios, RMB-dominated revenues, and substantial dollar debt, infrastructure and traditional industrial groups with weak cash flow and heavy reliance on dollar financing. Don't wait for debt defaults or bankruptcy liquidation to regret it. By then, your investment will be worthless. I also want to warn you not to be fooled by their low valuations. Some real estate stocks trade at a third of their net asset value (NAV), and some airline stocks have single-digit P/E ratios, but that doesn't mean they're good investments. Their NAV is inflated based on historical cost land and inventory, whose actual value has plummeted in the current market, and their profits are unsustainable. When real estate companies face debt crises, they're forced to sell assets at far below book value to raise cash, leading to massive NAV write-downs. Airlines' profits are highly dependent on oil prices and exchange rates. When oil prices rise and the dollar strengthens, profits quickly turn to losses. Even more terrifying is the contagious nature of these debt crises. A single developer's default can impact upstream and downstream suppliers and contractors, even triggering a sector-wide credit crisis. Just as Lehman Brothers' 2008 bankruptcy sparked a global financial meltdown, a major developer's debt default could trigger a chain reaction across China's real estate sector, threatening the entire financial system. International investors are already wary of this risk. According to India's Business Standard, global investors are pulling capital out of emerging markets at an alarming pace, driven in part by dollar strength and debt risks at emerging market companies. Chinese enterprises with high dollar debt are top targets for foreign sell-offs. So don't harbor illusions. Don't think the government will bail out the market. The government can rescue a handful of core companies, but not all those mired in debt crises. Don't assume exchange rates will rebound. In the current macro environment, RMB depreciation pressure far outweighs appreciation momentum. Don't bet on successful corporate transformation for capital-intensive, highly leveraged businesses. Transformation is harder than climbing Mount Everest. Investing is essentially a probability game. We need to do things with a high chance of success. Holding Chinese capital-intensive enterprises with high dollar debt is a high probability losing bet. So my advice is liquidate immediately and stay away from these ticking time bombs. Move your money into businesses with healthy balance sheets, no foreign currency debt, and stable cash flow. That's the right way to protect your wealth. The third category, and the one I disdain most and want to scold you hardest about, is fake tech Chinese concept stocks that survive on subsidies and have no ability to generate their own cash flow. You people are always dazzled by trendy buzzwords like technology, innovation, and disruption, but forget the most basic business logic. If a company can't consistently generate positive cash flow or make money from its core operations, it's not a real business at all. It's a scam, a Ponzi scheme that uses investors' money to tell stories. I love technology. Warren and I invested in BYD because Wang Quanfu and his team are real engineers who solve practical energy replacement problems, replacing gasoline-powered cars with cheaper, more environmentally friendly electric vehicles. Their technology translates into products, and those products generate profits. That's real technology, but many Chinese concept stocks I see only have technology in their PowerPoint presentations, in analysts' research reports, and in the hot air of their founders' speeches. What's fake technology? It's companies that claim to be building chips, making cars, or changing the world, but have no mass-produced products, and can't produce a single quarter of positive cash flow. Their only business model is surviving on subsidies and clinging to life via financing. According to Bloomberg data, over 40% of us listed Chinese concept stocks have reported consecutive annual losses for 3 years, and 15% of these companies derive over 50% of their net profit from government subsidies. These companies are like parasites, dependent on subsidies and investor capital to survive. The moment the host cuts off funding, they die instantly. I've seen countless storytellers in my life, from the 1960s electronics bubble to the 2000 dot-com bubble, and now the fake tech bubble. Every time, legions of people are swindled out of their life savings. These storytellers all share a trait. They avoid talking about profits or cash flow, focusing instead on the future, tracks, and user scale. They tell you current losses are for market share, but never answer, when will we make money? Or how will we make money? And Trump's policies will sound the death knell for these fake tech Chinese concept stocks. First, the Trump administration has made it clear it will strengthen targeted sanctions on China's tech sector, especially in so-called sensitive areas like semiconductors, artificial intelligence, and new energy. Most fake tech companies cluster in these sectors, and their core technologies either rely on imports or are copied, imitated. Once sanctioned, their supply chains will snap immediately, and their so-called R&D will become a river without a source. Second, the audit issues facing Chinese concept stocks will worsen further. Remember the 2022 Chinese concept stock crash? It happened because the U.S. Public Company Accounting Oversight Board, PCATO, demanded access to Chinese concept stocks audit working papers, and many fake tech companies dared not disclose them because their financial data was entirely fabricated. Subsidy income was packaged as R&D revenue. Related party transactions were hidden, and losses were whitewashed. After Trump takes office, he will inevitably ramp up oversight of Chinese concept stocks. Companies engaged in financial fraud will be forced to delist, turning your shares into worthless paper. Most deadly of all, the financing window will slam shut completely. These fake tech companies have no cash flow and survive solely on financing from U.S. stock markets. But amid trade decoupling and rising geopolitical tensions, U.S. investors will grow increasingly wary of Chinese concept stocks, and institutional capital will stage a mass exodus. According to Bank of America, over $20 billion has flowed out of Chinese tech stock ETFs since 2024. When the financing window closes, companies surviving on burn rates will either lay off staff and collapse or sell themselves at fire sale prices, leaving investors with total losses. I'll emphasize again, the fundamental difference between real tech and fake tech lies in whether a company has a moat and can generate sustainable profits from technology and products. BYD's moat is its blade battery technology, DMI hybrid system, and world-leading industry chain integration capabilities. The moats of these PowerPoint car makers or chip makers, however, are their PR team's rhetoric, their marketing team's traffic, and the false prosperity brought by subsidies. When subsidies disappear, financing stops, and sanctions hit, these moats will pop like bubbles. You're always eager to bet on the next Tesla. But you forget that before turning profitable, Tesla accumulated over a decade of technological know-how, built a complete production system, and cultivated a loyal user base. The fake tech companies in your portfolios have nothing but stories. In this hostile environment, their fragile business models will be the first to shatter, like paper boats in a rainstorm. So audit your portfolio. If you hold any of the following, liquidate immediately: Chinese concept stocks with consecutive annual losses and no positive cash flow for over 3 years, tech companies overly reliant on subsidies with weak core business profitability, concept-driven firms, PowerPoint car makers, fake chip makers lacking core technology, Chinese concept stocks heavily dependent on U.S. capital markets with no alternative financing channels. Pull your money out of these storytelling scams and invest in real assets that generate cash flow and have core technology. That's responsible wealth management. I've ranted long enough, and I suspect you're already breaking into a cold sweat. You're definitely asking, Charlie, so what should I do? Bury gold bars in my backyard. While I have nothing against gold, it is indeed a safe haven asset in turbulent times. I have better advice, rooted in the investment principles I've upheld my entire life, simple, unadorned, and proven effective. First, cash is king, or rather cash, like assets, are king. In the face of such immense uncertainty, holding cash is not cowardice, it's wisdom. Cash gives you options, allowing you to scoop up great companies at rock bottom prices after the storm passes. Right now, U.S. short-term Treasury yields are at attractive levels. 1-year Treasuries yield over 5%, a risk-free return and a gift from God to investors. Sitting still and earning steady interest is a privilege in turbulent times, one only rational investors can enjoy. The reason Warren and I have succeeded over the decades isn't because we're brilliant. It's because we understand waiting. We wait for good opportunities, wait for the market to make mistakes, wait for the storm to pass. Right now, Warren is sitting on hundreds of billions in cash, waiting for that moment. Don't worry about cash losing value to inflation compared to the risk of total asset wipeout. Inflation-driven depreciation is trivial. The first rule of investing is not to lose money. The second rule is to remember the first rule. When you hold cash, you have no risk of loss and always have a chance to bounce back. Second, if holding cash feels too boring and you want to do something, buy shares in global companies with strong pricing power. What's strong pricing power? It means people will buy their products no matter the economic climate or tariff levels, and they can easily pass inflation and tariff costs on to consumers. Companies like Coca-Cola, whether Trump raises tariffs or not, people will drink Coke, and its brand and distribution network give it an irreplaceable moat. Or Apple, people are willing to pay a premium for iPhones because its ecosystem and user experience are impossible for competitors to replicate. Or oil companies, no matter how global trade changes, energy is fundamental to human survival, and companies with high-quality oil and gas resources will never become obsolete. These companies have weathered countless wars, crises, and trade frictions. Their business models are rock solid, and their cash flow is stable and abundant. Investing in them isn't about chasing short-term surges. It's about protecting your wealth in turbulent times and ensuring steady asset appreciation. Remember, great companies are always scarce, and their value shines brightest amid storms. Finally, I'll leave you with a few pieces of advice, a summary of my lifelong investment career. I hope you'll keep them close to heart. First, avoiding stupidity is more important than pursuing brilliance. Most investors lose money not because they're not smart enough, but because they're greedy, easily tempted, and love taking unnecessary risks. Don't bet on policy. Don't bet on exchange rates. Don't gamble on things you can't control. Stay within your circle of competence. Only invest in companies you understand, and only do things with a high probability of success. Second, patience is the core virtue of investing. Investing is like planting a tree. You water it, fertilize it, and wait for it to grow slowly. You don't yank it up to make it taller. In this fast-paced era, people crave instant gratification, but investing requires delayed gratification. Don't panic over short-term market fluctuations. Don't follow the crowd just because others are making money. Be patient, and time will reward you handsomely. Third, always respect risk. The market is like nature. Its power is infinite. Never try to fight it, instead adapt to it. When a storm comes, the smartest move isn't to try to ride it out. It's to find a safe shelter and wait for it to pass. Those who try to catch a falling knife will only end up cut. 2025 will likely be tough. Trump's tariff stick will shatter many people's get-rich-quick dreams, and global trade decoupling will reduce many fragile assets to ashes. But I hope those of you watching this will survive and protect your wealth. Because as long as you survive, as long as you hold cash and high-quality assets, when the storm passes and the market returns to rationality, you'll realize that crises are also opportunities, and those who stick to their principles will ultimately be rewarded. I'm Charlie Munger. My physical body has left this world, but my wisdom will always accompany rational, patient, and risk-averse investors. I've made myself clear. The rest is up to you. Remember, investing is ultimately a cultivation of human nature. If you can overcome greed and fear and remain rational and patient, you'll outperform 99% of people. Good luck. You are gonna need it.